So today we're going to talk about different ways to structure real estate deals. I spoke at a conference over the weekend, and a lot of people were asking, maybe they want to raise money for their first deal or they want to go buy their first deal with a partner, but they don't know how to actually structure it. The first thing I tell everybody is go talk to a real estate lawyer. They're going to tell you all the different ways to do it, what the pros and the cons are. So at the very beginning, when you go to do your first deal, I do like the idea of doing it on your own because you're taking the risk. You're able to then show a model of what you've done, right? And it's a pretty tough sell to go ask other people for money when you don't have enough money to do the deal on your own. Because if you've, whatever you've done throughout your life, if you haven't been able to save enough for a down payment, why should you be the steward of other people's money? So I do think on the first deal or the first couple, if you can do them on your own, that's the best way to go. And then after that, maybe on the second deal or the third deal, I would get in if you did a partnership instead of doing something where there's a very heavy split of equity to you being the guy who's running the deal, unless you have a lot of experience or something to offer. I think a partnership is a good way to go. So if you're looking for your first partner, I do think it makes a lot of sense to go to friends and family, somebody you actually know, because there's going to be things that come up that you didn't think would happen, right? You might buy that first deal, it might look good on paper, and all of a sudden there's a big issue and you have to put money in. If it's somebody you really don't know at all, that's a pretty tough call to make. And if it's just you and them in the deal, you can't go to other people to get that capital because you're diluting the shares. You have to go back to the same two people that came in at the beginning. So if you're both, financially in a good spot, you have an understanding of what the risks are, and it can be somebody who you have a relationship with, there's trust there, and you're both able to put money in or take money out. That would kind of be the perfect structure for the first deal. The other way you can do it, for sure, if you want to own the assets on your own, that's not the model that I love, but if you're doing quicker, renovations or flips, you're going in and maybe putting bridge debt on a deal, and you think the value is going to go way up, you can bring in investors on the debt side. So you can just go borrow the money as a note. So you can say, I'm going to give you 10 or 15% interest for 1 year. At the end of that 1 year, all the investor has got out as the interest, and you were able to go refinance at a higher value, and you can keep the property. Now that works when it works. If the market changes during that renovation or interest rate change and you can't take the money out on the back end, that's where it becomes a little more risky. I don't like the structure myself. You're trying to time it in too short of a time frame. So it's 1 year or 2 years. You're trying to judge what the market looks like. You need the rents to go up in order to get that equity back out. So there's a lot more risk there. You're also probably going to lose a lot of money during that year, which you have to be aware of. If you're always going to pay higher interest on those type of investments. So if your investor comes in and they're getting 10 or 15%, you're paying interest on 100% of the building. And during the renovation, you're not getting, it might be half empty while you're renovating it. So you're going to lose a lot of money throughout that first year, or if it goes into the second year. So you want to make sure you have a really good thought out plan. I don't know if this is necessarily the best idea for the first deal. Maybe if you've done a couple already on your own and you can prove out the model, show how fast you can do the renovations, how quick you can get the money out. You're very, confident in the financing on the back end. You can do note investing. A lot of people do it. The upside to it is that you usually can own that asset 100% on the back end. So if you're doing this kind of investment, you basically have to be buying heavy value add, right? You can't be buying a new building. You can't be buying something that's not going to go up a lot in value. You have to buy an older building that needs a lot of work. You're going in, getting those rents up, and it could be through better management as well. Now, if you're in an area like, Toronto or Vancouver where the pricing is already very high and rents are already high, or there's rent caps and you can't raise rents, that's where that really doesn't work. You have to be in an area where you can get rents up and there's lots of room to move up in that market over the next year or 18 months. The other side of it is just a construction risk, right? For sure, if it's one of your first deals, things can take way longer. You might get into the property and there might be way more issues in there than you thought. It's going to cost a lot more, and it's just a length of time too. And then the time to lease it up on the other end, depending on the size of the building. But you might have these awesome units, maybe it wasn't the greatest neighborhood and now it's hard to get the rents that you want, and it takes 6 months to lease that building up. Well, that's 6 months where you're paying a very high interest rate on the entire loan, the bridge loan and the note that you took from the investor. So there's definitely some risk to this model, but it can work really good if it works. And then the last one, this is my favorite, this is what we do. Once you get a little more established, you have a model you can prove out to people, then you can start setting it up what we have is a limited partnership, and it's set up like a fund. So people aren't coming in on specific deals, they're coming in on all of our properties. With a limited partnership, there's lots of benefits. The general partners take all the risk depending how you set it up. The way we have it set up, the general partners take all the risks, so they're signing on the debt, and there's limited liability for all of the investors. So nobody's signing on any of the debt. They can obviously risk losing their investment, but nothing above that. The general partners are taking the risk. There's going to be some type of a fee structure. For us, there's a hurdle rate, and then after the hurdle rate, the investors are getting 80%, we're getting 20%. That split I've seen it be 50-50 with no hurdle rate. There's really no right or wrong way to do it, and you can structure it kind of based on your expertise. What are you bringing to the table? For us, we made our fee structure very aligned with the investors because we were looking for scale. So we didn't try to make our business model built out on fees. We wanted it to be aligned with the investor, so we both get big benefit from scale. With a limited partnership, there's lots of tax benefits. Again, a tax accountant could kind of walk that through, but depreciation can flow down through. It's a little harder to set up. If you want to set it up correctly, it's going to cost quite a bit of money with a lawyer. So I wouldn't do it necessarily on the first deal, or you'd set up a very small version of this. But I think later on, if you're going to be bringing in, 10 or 20 investors, you need the proper structure. It's very hard to scale something like node investing, or if you're doing partnerships on every single deal, it's very hard to scale that over a large portfolio. Something like a limited partnership allows you to do it where you're bringing in lots of investment and you can buy deals throughout a certain period of time. So for us, we had the trailer parks initially, then the first 2 multifamily deals we had bought on our own before we rolled them inside of the fund that we have. So we could go to investors and say, hey, here's what we're doing. This is what it looks like. This is the kind of properties. These are the returns we're getting. And you can offer them something so they can see the benefit in partnering with you. That's very hard at the beginning if you have nothing to offer and you're saying, hey, I want to take a bunch of the upside. You're going to bring in all the capital. So that's why doing something like a partnership might make sense at the beginning. Once you get some scale and some credibility and you can prove out what you're doing and that it works, that's when you could set up a more of a structure like a limited partnership. You'll also find, depending on the investor, but more wealthier people will look for different things. They don't necessarily care about getting a ton of money out right away, so they're more likely to do longer term holds. They just want security. So the fact that they can't lose anything above their investment, if it's someone who owns like a medical corp or something like that, that's a big benefit to them. They're not risking anything above that. They also don't have to do any other work. So you're, as the GP, generally doing all the work. You're finding the deals. You're doing all the financing. So you're offering something. There's a benefit, and both parties are getting something out of it. So today on the episode, we talked about different ways to structure deals, different ways to bring in funding. Again, my recommendation is always talk to a lawyer, talk to an accountant first, and come up with a plan from there. It kind of got me going on this topic because I had talked at that conference, and a lot of the questions I got asked were about this. I'll be putting on a webinar in November just to talk about stuff like this, structuring a deal, how to bring in capital, how to scale multifamily. If you guys are interested in that, there'll be a link in the show notes. Look forward to seeing you there.